Welcome back to Silver&Metal IQ. Today's video is not just another price update, it's a reality check. There's an old saying that it's better to be smart in a room full of average thinkers than brilliant in a room full of geniuses. In markets, that matters more than most people realize. The real edge isn't intelligence, it's positioning. And right now, the weakest competition in the financial world is still trusting banks, paper promises, and manipulated markets. That's why the smartest move isn't trying to outplay the system. It's stepping outside of it and holding physical silver. Panic buying for silver has officially returned. Not quietly, not gradually. It's loud, visible, and accelerating. And today, we're going to break down exactly why this is happening, how everyday investors should approach buying physical silver without getting ripped off, where the traps are in the retail market, and what the next 30 days could look like for silver prices using a mathematically grounded Fibonacci probability model. We'll also connect this directly to what's unfolding in Venezuela and why global instability always finds its way back into precious metals. Let's start with the numbers, because price tells a story before headlines do. At the time of recording, silver futures are sitting just under $76 an ounce. Earlier today, futures briefly surged above $77, confirming that silver is once again in an explosive phase. But futures don't tell the whole story. If you want to understand what's really happening, you have to look at physical silver, because that's where stress shows up first. Physical silver trades off the spot price, which is typically $1 to $2 higher than futures. And on top of that, buyers are paying premiums that continue to expand as inventories disappear. This gap between paper silver and physical silver is not normal. It's a signal. It tells us that demand is not being driven by speculation alone. It's being driven by fear, protection, and a loss of trust in the system. When investors rush into physical silver, they aren't chasing charts. They're reacting to something deeper. They're reacting to inflation that never truly went away, to debt that can't be repaid, and to financial institutions that appear stable on the surface but fragile underneath. This is why silver behaves differently than stocks. Silver doesn't need confidence. It thrives when confidence breaks. What's important to understand right now is that not all silver buying is equal. There's smart accumulation, and then there's emotional panic buying. And those two paths lead to very different outcomes. Knowing how to navigate that difference is critical, especially when supplies are tight, premiums are rising, and misinformation is everywhere. And that's exactly where we're going next. Because before you buy a single ounce, you need to understand where real value exists in the physical market, and where it doesn't. If you're thinking about buying silver right now, the first thing you need to understand is that not all physical silver is created equal. There's bullion, and then there's collectible coins. Bullion is raw, standard, liquid, the type you can sell anywhere in the world without debate. Collectibles? Beautiful maybe, but illiquid, overpriced, and often driven more by hype than intrinsic value. For serious investors, bullion is the only option that matters. When it comes to sizes, the 1-ounce rounds are king. They offer liquidity and flexibility. Bars are also important, but you have to consider your goals and storage capabilities. The market typically moves in 3 standard units: 1 Oz, 10 Oz, and 100 Oz bars. Each comes with its own pricing dynamics and premiums. For example, a 100-ounce bar may seem cheaper per ounce at first glance, but upfront costs are higher and delivery may be slower. Retailers may even impose extra fees unless you use a wire transfer or check. This is why comparing every option matters. Don't just buy the first bar you see. Some retail distributors are delivering better deals than others. Bullion Express, for instance, has been able to keep some products close to spot price, a rare opportunity in today's environment. SD Bullion also offers 100-ounce bars, but to access the lower prices, you often have to buy in bulk. If you don't, the apparent discount disappears. The takeaway is clear: shop carefully, compare premiums, and always calculate your total cost, including delivery and fees. Panic buying is happening, but smart shopping will protect your capital. Right now, retail demand is breaking records. This is not industrial demand. It's everyday investors, mom and pop, reacting to the uncertainty around banks, currency, and inflation. When supply chains slow down, prices spike and premiums expand. Understanding these market mechanics is critical. Buying blindly into scarcity without strategy exposes you to overpaying at exactly the wrong time. Another key factor is the spot price versus futures. Spot reflects the physical market, while futures reflect paper contracts. Typically, spot trades slightly higher than futures. But right now, the gap is widening. A warning sign that real silver in your hands is far more valuable than what you see on a trading screen. If you want true protection for your portfolio, you need to hold the metal, not just a digital number. Physical possession changes everything. It's a hedge against systemic risk that paper contracts cannot replicate. Finally, let's talk timing. A common question is, should you buy all at once or scale in? The answer is scaling in. Never put your entire allocation into one lump sum. By spreading purchases over several weeks or months, you reduce risk, manage premiums, and avoid chasing spikes driven by panic. This is not speculation. It's disciplined accumulation. Silver has historically responded to crises in predictable ways, and scaling in allows you to take advantage of market cycles without overexposing yourself. The key here is simple. Educate yourself. Know the difference between bullion and collectibles. Calculate premiums, and always focus on physical possession. Don't get caught in hype. Don't follow the crowd blindly. This is how you protect wealth in turbulent times. And in the next segment, we'll take this strategy a step further by looking at the math behind silver's next 30 days, using Fibonacci ratios to give you a quantifiable, probabilistic view of what could happen next. Now that we've covered how to safely acquire physical silver, let's talk about what the market may do over the next 30 days. And I'm not just guessing. We're going to use the Fibonacci ratio, a mathematical tool that's been used for centuries to study natural patterns, cycles, and probabilities. This isn't about crystal balls or hype. It's about quantifiable probabilities. The same ratios appear in your own body, in flowers, in spirals, in historical price movements of markets. They're not magic, they're patterns. And when applied correctly, they can help investors anticipate potential turning points in silver pricing. Right now, silver futures are volatile, spot prices are rising, and premiums for physical metal are expanding. Panic buying is creating sharp short-term surges, but the Fibonacci ratio helps put this volatility into context. Based on historical cycles and mathematical probability, a 30-day projection suggests silver could approach $102 per ounce. Does that mean it will hit exactly 102? No. But it gives a structured framework to anticipate likely highs and lows, helping you plan purchases strategically rather than emotionally. This is where disciplined investors shine. Most retail traders panic during spikes, paying maximum premiums for minimal long-term advantage. By using Fibonacci ratios and probability-based reasoning, you can scale in at optimal points. Start with smaller allocations during surges, add more during pullbacks, and never risk more than a planned percentage of your portfolio at any single price level. This isn't speculation. It's calculated risk management. Let's put this in perspective. Imagine you have $50,000 allocated for silver. Instead of buying all at once at $77.83 per ounce, you might split it over 4 purchases. If the market dips to $74 or spikes to $80, you're not overpaying and you're not sitting idle. The Fibonacci framework gives you a reference for likely market behavior, turning chaos into strategy. Physical ownership remains the ultimate goal, but timing your acquisition can maximize your position without taking unnecessary risk. Another point to consider is correlation across precious metals. Silver rarely moves in isolation. Gold, platinum, and palladium have their own cycles, but often mirror silver's moves. By analyzing silver with Fibonacci ratios and tracking correlated metals, you gain a multi-dimensional view of market dynamics. This allows you to anticipate liquidity stress, premiums, and even potential opportunities for arbitrage. Finally, remember that probability isn't certainty. Markets can be influenced by unexpected events, geopolitical tension, regulatory changes, or sudden retail panics. But by using Fibonacci as a quantifiable guide, you reduce emotional mistakes and make informed decisions. Silver isn't just a commodity, it's a portfolio anchor, a hedge, and a store of value. And when you combine disciplined acquisition, physical possession, and probability-based planning, you're not just investing, you're taking control of your financial future. As we move beyond the charts and probabilities, let's examine the real-world events that are shaking global markets and why silver investors need to pay attention. Venezuela is unraveling faster than most analysts predicted. The nation, once rich in natural resources, is now in economic collapse. Its oil infrastructure is in shambles, banks are strained, and the government's assets are being contested on multiple fronts. This isn't just a local issue, it's a signal for global markets. Every ounce of silver, every dollar invested in precious metals reacts to these geopolitical shocks because investors flee uncertainty and seek stability. Recent events, like the arrest of Maduro and the U.S. intervention, have triggered massive shifts in commodity markets. Oil stocks like Chevron and Exxon surged immediately, showing how political moves can ripple through investments. For silver, the effect is subtle but powerful. As confidence in fiat currencies wavers during crises, precious metals surge as a hedge. This is why timing and physical possession matter more than ever. Paper gains in futures contracts can vanish, but owning tangible silver shields you from systemic shocks. Meanwhile, China is playing a quiet but strategic game in Latin America. Rather than overt military threats, they are using legal and economic leverage to protect their interests, particularly in Venezuela. Belt and Road investments totaling over $1.3 trillion across 150 countries are now tied to legal frameworks that make regime changes complicated and expensive. For investors, this demonstrates a critical lesson. Commodities don't move in isolation. Political, legal, and international agreements directly impact supply, premiums, and long-term market stability. Understanding these factors gives you an edge over casual traders who only watch charts. But Venezuela is only one example. Across the globe, nations like Cuba, Colombia, and Greenland are facing crises influenced by political decisions, energy policies, and social instability. Take Cuba, for instance. Its citizens are trapped in a system that cannot sustain itself without external support. Or Greenland, where strategic resources make it a point of international tension. These geopolitical flashpoints often precede market movements in precious metals. As a silver investor, recognizing these signals can help you anticipate surges and price shocks before they hit retail markets. What does this mean for your portfolio? First, never underestimate macroeconomic context. Your physical silver isn't just a hedge against inflation. It's protection against geopolitical instability, currency manipulation, and systemic fraud in global finance. Second, timing matters. While Fibonacci ratios guide your purchases, understanding global events helps you avoid panic buying during spikes and take advantage of dips when markets overreact. Third, diversification within metals is key. Gold, platinum, and palladium often respond to similar macro events, so tracking correlated moves strengthens your investment strategy. Finally, remember that knowledge is power. Most retail investors react emotionally to headlines. By contrast, informed investors analyze the facts: who is making the moves, what leverage they hold, and how these decisions will ripple through markets. Venezuela's unraveling is a prime example. The chaos creates opportunity for those who are prepared, disciplined, and strategic. In the next part, we'll break down practical steps for purchasing silver, avoiding common pitfalls, and making your investment both safe and profitable, including how to navigate premiums, shipping delays, and retail constraints. Now that we understand the macro events shaking markets, let's talk about the nuts and bolts of buying physical silver. the kind that actually sits in your hand, not just numbers on a screen. Panic buying is back, and if you don't approach it carefully, you'll overpay or get stuck waiting for weeks to receive your metals. First, let's discuss what to buy. Forget collectible coins or novelty pieces. Those are for hobbyists. For real investment, focus on bullion, silver rounds, 1-ounce bars, 10-ounce bars, and even 100-ounce bars if your budget allows. Liquidity is key, so stick to commonly recognized sizes that are easy to sell when the time comes. Next, where to buy is just as critical. Retail distributors like Bullion Express, SD Bullion, and similar platforms often offer competitive pricing. But don't take the listed price at face value. Always check the spot price, which reflects the current market value of silver. And remember that physical silver usually carries a premium above spot. This premium fluctuates based on demand, shipping, and global events, and it can make a huge difference if you're buying in bulk. Timing your purchases when premiums are lower can save hundreds or even thousands of dollars if you scale your investment strategically. Shipping delays are another real-world hurdle. The surge in retail demand means suppliers often run out of stock, especially for larger bars. Bullion Express may have deals today that are gone tomorrow. SD Bullion might require minimum orders to unlock discounts. As a silver investor, patience and flexibility are essential. Place smaller, strategic orders to secure inventory without overcommitting, and avoid rushing just because of a temporary price spike. Remember, owning silver is about long-term protection, not day trading hype. Now, let's talk strategy. The old-school approach is simple. Buy in increments, not lump sums. Allocate a fixed percentage of your net worth and gradually acquire silver, gold, or other precious metals. This reduces risk, smooths out price volatility, and ensures you don't panic if a short-term spike or dip occurs. Use a combination of rounds and bars depending on your liquidity needs. Smaller rounds for flexibility, larger bars for long-term storage. If you're dealing with hundreds of ounces, storage solutions become critical. Secure home safes, depositories, or allocated vault accounts. Finally, protecting your investment goes beyond simply owning silver. Futures, options, and hedging strategies exist for retail investors who want to safeguard against price drops. Even basic knowledge of puts and call spreads can help you maintain your portfolio's value while keeping physical silver in your possession. But here's the core principle. Nothing protects your wealth better than having tangible metal in hand outside the banking system. When markets panic or currencies falter, your physical silver is yours, untraceable, untouchable, and immediately deployable. We're connecting all the dots, from physical silver strategy to global market signals, and giving you a 30-day silver price forecast using a quantifiable, historically backed method, the Fibonacci ratio. But first, let's recap why silver matters today. With panic buying surging, delays in deliveries, and global events like Venezuela's unraveling, owning physical silver is not just smart. It's essential for preserving wealth against financial instability. Using the Fibonacci ratio, which appears throughout nature, human anatomy, and financial markets, we can estimate probability-based price trajectories. While no method can predict the future with absolute certainty, historically, metals like silver, gold, and platinum often follow these ratios during major market moves. Applying this to the next 30 days, silver's price shows a potential range around $102 per ounce, gold near $4,820, and platinum around $3,000, assuming current macro conditions persist. This doesn't guarantee results, but it gives investors a mathematical framework to think about trends instead of reacting emotionally to headlines. Global signals are equally important. From China's legal maneuvers in Venezuela to U.S. interventions and policy shifts, geopolitical events continue to influence metal demand. Oil markets, infrastructure rebuilding, and industrial activity in emerging economies all affect supply and demand for precious metals. Investors must understand that these are leading indicators, and by following them, we can anticipate price swings before the broader public reacts. But the key takeaway remains simple. Diversify, scale in, and protect your wealth with physical silver while using paper markets strategically if you're knowledgeable about options and futures. Now, let's close with practical advice for your portfolio. Allocate only a portion of your net worth to metals, scale purchases over time, and always prioritize liquidity and storage security. Avoid collectibles unless you enjoy the hobby. Focus on recognized bullion rounds and bars. Monitor global developments. Keep an eye on premium fluctuations above spot prices, and remember that patience is your friend. Markets move in cycles, and the investors who thrive are those who stay informed, calm, and strategic. Financial disclaimer: all information provided in this video is for educational and informational purposes only. Silver, gold, and other precious metals carry risks, including market volatility and liquidity issues. Silver&Metal IQ does not provide personalized financial advice, and nothing in this content should be considered a recommendation to buy or sell any asset. Always perform your own research, consult with a qualified financial professional, and consider your personal financial situation before making investment decisions. Past performance does not guarantee future results. By taking action based on this content, you acknowledge and accept these risks. That wraps up today's full breakdown of silver market dynamics, buying strategies, Fibonacci-based forecasts, and global macro insights. Remember, knowledge is your most powerful asset, and holding physical metals is a tangible way to protect your wealth against financial uncertainty.